and I've started noticing this very recently, is that let's say up to 2019, everyone talked about cap rate compression. I think what was more interesting was the cap rate convergence that across sort of regions or asset qualities, like everything moved to the same level. So like maybe you'd pay a better cap rate for a newer, nicer deal. You also pay a lower one because you thought there was upside. And
Yeah.
then what I'm seeing now is that in some of the more sleepier markets, let's say, or some of the older asset types, there is actually a cap premium. So like you can buy traditional workforce type stuff without having to bet that you're going to raise rents 30% 3 years.
Just to
And
make the deal work.
exactly. Like it's just, you're going to buy this, big old thing and it's going to be a beast to manage, but you're going to be getting the coupon like over time. And at least from an underwriting perspective, that seems to be back now. Things feel a lot more like they did, I don't know, 10 years ago than they did 5 years ago. I'm okay with that.
Yeah. Yeah, we did see a big run up and it was for a while. Okay, yeah, we'll show a 15% increase in our year one pro forma. And it was what you had to do to get the deal, but also how it would actually trade, if not even higher than that. And it's crazy, but that's the way the market was.
Yeah, there's a lot of the pushback, and it makes sense too. I'm not saying people see positive leverage point. You're having to justify how you get to some promised land by the second or third year. And the pressure that like the hoop you had to jump through isn't quite there anymore. It's more valuing things for all the reasons you wanted to before.
Yeah. When you guys are executing on a value add, have you found things that are uh, the best drivers of, is it ceiling fans? Is it kitchens? What have you found there?
I joke that my job can be boiled down to finding places to add plank flooring and laundry sets. So those are probably the two items highest return. It's no brainers. So we add them pretty much wherever we can. A lot of what people don't think about, I think, are just like ancillary income drivers as well. Like longer sets, cable and internet packages, the things that people like me can eye roll out like fenced in yards and things like that are always in the broker books, but they actually make a lot of sense and add a lot of value beyond just saying you're going to add the new quartz counters or whatever. Something that has happened with the decline in fundamentals is I think the like return on investment of like kitchen renovations overall has gone down. Just that it's harder to show like the spread basically in rents. So what maybe was 25 or 30% return on investment is probably more 15 or 20.